Now let's get to our stock of the day. Now we've got actually, Phil, you mentioned data center, the investment that's going on there at the moment globally, particularly here in Australia. We're going to get across a few. Let's get there in terms of our stock of the day. It is Infratil. Now it owns a 49.7% share in CDC data centers, and CDC saying it has secured the largest data center contract in Australia's history. The 555 megawatt deal is with a US investment grade customer on a 30-year term. And when fully deployed, the company expects annualised EBITDA with fair value adjustments of approximately 2 billion Australian dollars and new FY26 capital expenditure guidance of 4 billion. That is up from 2 billion in FY26. Phil, how do you see that playing out for Infratil?
It's flavour of the month, the old data centres. A couple have raised money recently, and for similar, their largest contract bids, and they've run heavily. Couple of things I would point out. It is flavour of the month. Some will argue stronger for longer. Always at least consider valuation, how much has been priced in. That's a volatile share price. You can see people loved it in August, hated it in February, March. Now it's back in vogue again. Consider, are they a pure play data center operator, or do they have other assets that people have stopped talking about because of the excitement in data centers? Consider what you're paying for. Consider their ability to deliver on time and on budget. There's a lot of talk about the data center build. There's still a debate about how we're going to fuel the data centers. How are they going to get the energy they need without sapping too much from the grid? And we're hearing more and more local councils saying, be careful, we need to see a planning bit. So it's easy to put numbers into a spreadsheet and say these companies are worth a lot of money. In practical terms, how are you going to fuel it? Our house view remains nuclear is the best way, but are we going to get that in Australia? Probably not in the near term. So relying on the grid, relying on renewables. So it's easy to put this build in your spreadsheet and say they'll deliver on time and on budget. At the current share price, the risk is to the downside. It is not a pure play. About half their business is CDC, so half is other stuff. I believe they have a significant New Zealand exposure as well. It is now expensive based on consensus price targets, minimal 1%, 1.5% dividend yield, 60 times almost FY26 PE. You are paying a full price, almost assuming nothing can go wrong. At this price, I would cash in, I'd take my profits and I would sell, because execution risk is real. If you've made money, I would sell it. It's not a pure play, great business, but appropriately priced. Sell and switch into one of the other stocks we're about to talk about. Indeed,
because we do have a few opportunities just in regards, say, if you're particularly a pure play data center operator. Michael, how do you see it? And if you had a look at the chart, what is that telling you?
It has been a bit of a messy chart. I mean, there was a nice trend to it up until about a year ago. Yeah, look, I mean, broadly agree with Philip. I mean, I'd be happy to hold it here and just maybe see if you can hold on to those gains and maybe squeeze another couple of days up. I wouldn't be buying it here, that's for sure. So, happy to hold and maybe look to see if you can get a little bit higher before selling. But agree with the key points. It's not a pure play. They have renewable projects as well. They're trying to divest those. The flavour of the month, I think that's that is a big thing to consider. So we do have a situation where you could sort of sit on the side of the fence where AI is brilliant. Everyone's underestimating the growth of this thing and the data centres, and then on the other side, there's those that feel as if everyone's getting a little bit too excited. And the reality is going to be a lot more difficult. Obviously, try and gain access to energy, but also, just the cost to do anything is going up. So, if energy costs are going to be higher in the next couple of years, that flows through just to everything. So everything becomes more expensive. Margins start blowing out. Labour costs go up. It could be a lot more difficult. So. Yeah, it's a very tough area now to, I guess, try to predict where it can go in the next couple of years. I mean, if this was a $10 stock, it'd be an easy decision to make. But yeah, I agree with Philip. Up here, it's a bit stretched. I'd be leaning towards selling it in the next few days if you can, squeeze a bit more out.
All right. You like flying close to the wind then. You're prepared to hang in there for another couple of days.
I don't have that skill.
All right, timing. All right, so that is a hold and a sell, but potentially that hold will turn into a sell. So you've got to be vigilant. All right, that is our stock of the day. Infratil.